Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on a bankrupt nation. This is a story about a small island nation that consistently has run high current account deficits. It's an open economy with a floating exchange rate, and in 2006 its current account deficit rose to 15%. Its banks have been heavy borrowers offshore in the last couple of years. Who am I talking about? Iceland. Iceland today announced that it is basically bankrupt. Its banking system has collapsed and international banks will no longer do business with Iceland's banks. That means Iceland can't pay for its imports. What has that done? Well, queues have formed outside petrol stations in Iceland because people are worried there won't be any petrol left in the country. Iceland imports all its food, although it's a heavy exporter of fish. People in Iceland might quite like fish fairly soon. In fact, there was so much concern there today, or last night, that the head of the health system warned the media and people not to frighten old people by telling them about what had just happened to their nation. This really is amazing. The government now has asked the state pension plan to bring money back to Iceland from where it had been invested elsewhere, simply because the country has run out of money. Standard & Poor's has cut its sovereign credit rating to Iceland to BBB. Just got to remember that just 2 years ago, Iceland had a GDP per capita twice as big as New Zealand, and its credit rating was the same as New Zealand, about AA. Now, to be fair, comparing Iceland with New Zealand isn't particularly fair, but Iceland has about 300,000 people, we've got 4 million. Iceland is twice as wealthy, was until yesterday, twice as wealthy, but it does export agricultural products as its main thing. About 70% of exports are fish, and until yesterday at least, it had an unemployment rate of 1%. The point of this story really is to say that a nation that runs a high current account deficit for a long period of time, that borrows heavily overseas, is at risk of an exchange rate and banking system crisis, which would eventually bankrupt the nation. Now, I'm obviously not saying this is going to happen for New Zealand, but we have run current account deficits too high for too long. Ours hit just over 9% in 2006, and it's still over 8%. And our national debt has risen sharply in the last 4 or 5 years as we've borrowed heavily to invest in property. A cautionary tale, therefore. Iceland, a small island nation, has just gone bankrupt. I'm Bernard Hickey for interest.co.nz.